PayPal has experienced the biggest sell-off in their history, mainly because lower than expected growth, as the company didn't manage to keep their growth rates at historical rates in the range of 15% to 21%. From there, the company continued to struggle with restoring investors' confidence, which led to a steady multiple decline in the last years. I believe that despite the lower growth rates, the company is currently too cheap to ignore. Here's why. Within our valuation, we are analyzing PayPal's market cap in 3 different scenarios. We keep things simple and just use the revenue as the adjustable metric. For the operating margin as well as the cash conversion, I assume that they are going to stay constant at the average rate of the last 4 years in our analysis. For some additional margin of safety, I just assumed a FCF conversion rate of 100%. The anticipated EBIT margin of 16.4% is also well below their current margin of 19.6% as of Q1 2025. For a first scenario and as our bottom line, we first assume that PayPal doesn't manage to grow at all in the next 8 years. Within this scenario and with our rather conservative assumptions, PayPal seems to currently be trading in the fair value range. Analysts are currently predicting low single-digit growth rates in the next 3 years. Let's see how these influence the valuation. By just plugging the growth assumptions for 2025, 2026, and 2027 into the DCF, we get the following fair value market cap. After 2027, I still assume no growth. With these growth rates, we already get a potential undervaluation of 16%, as the fair market cap in this scenario is at $78 billion. In the last scenario, we assume growth rates in the range of PayPal's historical rates. Like mentioned in the intro, the company's growth has slowed down significantly in the last 3 years. That's why in this scenario, we only assume a top-line growth rate of 7% per year. For context, experts currently predict the digital payment market to grow in the range of 15% to 22%. With our anticipated growth rate, we are therefore playing it safe and nevertheless account for the lower growth rates of recent years. By anticipating a revenue growth rate of 7%, PayPal's fair value market cap is at $107 billion, indicating a potential upside of up to 58%. There are plenty of competitors in the global digital payment market vying for PayPal's market share. Through PayPal's dominant position, the company is up against competitors in almost every area, peer-to-peer payments. In this market segment, PayPal and their product Venmo is mainly competing with Block's Cash App as well as Zelle. Cash App has been able to build an impressive user base by integrating simple banking features, investing, and instant P2P money transfers into an easy-to-use app. Zelle is backed by traditional banks like Bank of America, JP Morgan, and Wells Fargo, and therefore dominates through direct integration into existing bank accounts. Online checkout. Stripe and Shopify are quickly pushing into this segment. Stripe is often the go-to alternative for customers seeking for cheaper alternatives as well as more flexibility. Shopify has also been pushing into this segment through their Shopify Payments initiative, vertically integrating their payment solutions into their already existing e-commerce presence. Digital wallets. In this segment especially, Apple Pay has emerged as a serious threat. Through their massive ecosystem with millions of Apple products, the company was able to seamlessly integrate their Apple Pay and wallet into their already existing products, further capitalizing from their already existing customers. Google Pay and Google Wallet are doing similar things, as these apps are often pre-installed on Android phones. Within our 3 scenarios, we are, in my opinion, already accounting for the intense competition that PayPal must face through the compressed top-line growth rates we assumed. Even when considering zero growth for 8 years and reductions in operating margins as well as a compressed free cash flow conversion, the company is currently trading at the fair value range. On the other hand, when anticipating more realistic growth rates of 7%, which is still conservative compared to the estimated underlying market growth rates of 13% to 21%, PayPal could even be undervalued by 58%. Considering this, I believe that PayPal is currently too cheap to ignore, which is why I currently rate the company a buy. What's your perspective on PayPal? Do you use these prices to buy? I am currently also buying ASML and Taiwan Semiconductors. You can see my reasoning behind these two picks in these two videos here. See you in the next one.